All right, the biggest Wall Street firms face questions after posting their worst quarter since the depths of the financial crisis. How did they do that? Joining me now for more on this topic and how Europe's debt crisis affects U.S. banks, we have Douglas Borthwick, head of FX trading at Faros Trading, and also William Cohan. Bill Cohan is a Bloomberg View columnist, Bloomberg contributing editor, and the author of a trio of books about Wall Street. Let's talk about them. Money and Power, How Goldman Sachs Came to Rule the World. Next one, if we've got it, The Last Tycoons. Do we have that there? No, and also The House of Cards about Bear Stearns. Most recently, as I mentioned, Money and Power. Bill Cohan, always a pleasure.
Nice.
All right, so in the context and the history of Wall Street, I've mentioned you've written three books. You got the Bear Stearns book, Lazard, as well as the most recent one on Goldman Sachs. Where do you place this quarter's results?
Oh, this is bad.
Bad.
This is bad because not only do you have, I mean, what I like about Goldman is it's kind of a pure play reflection on the capital markets. So yes, they had one-time mark-to-market write-downs that affected, they had like $2.5 billion of one-time charges, you know, $1 billion related to their investment in ICBC, the big Chinese bank. But even taking that out, and if they didn't have that, they'd be profitable for this quarter. And I think that's why the stock went out. But even taking that out, you see that their investment banking revenues are down, their trading revenues are down. I mean, it's really tough out there for pure play investment banks. And the big banks that made money in the quarter, well, you know, they all made it through accounting gimmicks and one-time gains and things like that. It is really tough for Wall Street investment banking.
Doug Borthwick, when you take a look at the business that banks are in now, do you think that they're going to exit more of their operations?
I think we'll probably see some deleveraging. Going back to the gimmicks, the accounting gimmicks, I think it's interesting that when the CDS blows out for a U.S. banking institution,
credit default swaps, right?
That they then earn money from that on their accounting.
Right, because the value of their debt is lower and they get to buy it back and they book it as a gain.
So maybe we should suggest to Greece that maybe they do their accounting the same way as a U.S. financial institution, and maybe then have a GDP of 60%.
But they need the money to actually go and buy back the debt, don't they?
They're about to get it.
You think that they are?
Absolutely, yeah, on Wednesday. On Wednesday, the check may not be written, but certainly it's coming, and it's coming hard.
You think it's going to be the last check?
I think it will be for Greece, yes.
What happens after that?
Well, I think you'll have a recapitalization of all the European banks. I think that people will stop talking about Italy and Spain being the next ones to fall. I think that there will be a tremendous amount of recap, and I think that that's going to be very important. But also haircuts. You know, Greece won't have this burden of 145% debt to GDP. It'll be 50% of that. It's going to be around 75%, which is a lot less than the U.S.'s debt to GDP ratio.
Bill Cohan, recaps and haircuts. Let's start with recaps. Where are the European banks, in your opinion, going to get the money for these recapitalizations?
Well, according to my friend Doug, they're going to get it from, you know, central banks, IMF, you know, I mean,
taxpayers.
Well, who pays?
Ultimately.
You know? I mean, it's like who owns the Fed here in the U.S.? I mean, is that taxpayers, other banks? I mean, what is that? Is that the capital markets? It's really tough to know.
You don't sound convinced here.
Well, I mean, he's the expert on Europe. I mean, if he says Europe is going to get recapped and there are going to be haircuts and everybody's going to be fine, then I'm okay with that.
You think that the U.S. taxpayer is okay with that? I mean, if money comes from the International Monetary Fund, that's U.S. taxpayer money. I think we're entering a political season, aren't we?
Well, I think the U.S. taxpayer, as we know, if you care to go to downtown Manhattan or any other city, frankly, on the face of the earth these days, you know, I think the taxpayers are pretty much fed up with the way that Wall Street was bailed out in toto by the U.S. government, and the way that basic, you know, people who are working for a living, as opposed to people who are enjoying getting paid by taking money from people, not taking risks themselves, that I think that they're fed up. Tremendously fed up with that bailout, and they're not getting anything. And I think that that's reflected in all these cities, even though it's not being articulated particularly well. But I think the time has come, you know, for the little people to start getting something here.
U.S. banks reeling from the latest quarterly results. Many are concerned about their exposure to Europe's sovereign debt. My guest, Douglas Borthwick, head of FX trading at Faros Trading, also with us. Bill Cohan, Bloomberg View columnist, Bloomberg contributing editor, the author of a trio of books on Wall Street. The latest one, of course, is Power. Isn't that the one? Money and Power, the history of Goldman Sachs. You also did the one on Bear Stearns, right? The Last Tycoons. That was Lazard. and House of Cards.
Exactly.
Bear Stearns,
I knew
the
we'd get it
trio,
all
right?
out.
It's all three.
The trilogy.
The trilogy.
The Wall Street trilogy.
All right, so you didn't seem very convinced with Douglas Borthwick's idea that there was going to be more money for European banks. Tell me about haircuts now. The amount of money that European banks are going to have to write down on their balance sheets if they actually do mark-to-market accounting.
Well,
Can't they just adopt maybe, a financial accounting standard, FASB, one was it 149?
Well, the banks in this country didn't have to take any haircuts. Everybody here got paid 100 cents on the dollar for CDS that they had with AIG. I mean, I assume Doug, again, is the expert. He would know whether or not they're going to have to take the haircuts over there that they didn't have to take over here. I mean, it worked out well here because everybody got close to 100 cents on the dollar. And it sounds like creditors in Europe are also going to do okay.
It's giving you that gimlet eye. It always reminds me of the joke, you ask the banker for a loan, and how do you tell which is the real eye? The real eye is the fake one, because that's the one that's most sympathetic. Borrowing money right now at European banks. You were listening to former UK Prime Minister Gordon Brown saying that wholesale funding, is a problem for European banks.
I think funding is a problem right now because people are questioning the credit quality of each and every bank. I think that'll be relieved on Wednesday when they see what sort of package exists. Talking about haircuts, right now they're marked around 21% off, so 79 cents on the dollar. They're talking about haircuts now of around 50 cents on the dollar, and Greek debt's trading around 40 cents on the dollar. So it depends where you bought it. If you bought it at 40, that haircut of 50 sounds not so bad. It's a 20% rally for you. If you're long at 81 and it goes down to 50, well, you've just lost 31% on your Greek exposure. But Greek exposure isn't that much, and you're going to get this huge inflow of money in a TARP-like system through this fund, which is the EFSF and the ESM funds both joined together would have more than enough money to be able to recapitalize the banks.
Well, mixed into that cocktail, the notion that European banks are going to have to increase the amount of money that they hold on their balance sheets. I think they're talking about 9%, but that's also under negotiation. And also, you're going to get what? European stress tests for the banks based on their sovereign debt holdings.
That's right. There are new stress tests coming. And once the stress tests come out, we'll see just how much actually needs to be added in there. What's interesting, though, is you're seeing a lot of banks, French banks particularly, selling overseas assets and repatriating their money. But also, where's the recapitalization going to come from? It's not going to come from necessarily the Eurozone. If they're bringing in new money, it's going to come from the Middle East. It's going to come from Asia. And what do they need to do? They need to buy euros. And so at this point in juncture, we see anyone that's short the euro hoping for something bad to happen or not to happen in Europe. We really believe they're just on the wrong side of that trade. That if anything, the guy that sleeps better at night right now is the guy that's long euros rather than short. And if you look at the Bloomberg median of the expectation of where the euro should be at the end of the year, it's around 135. It's trading at 137.80 right now. So you're looking at what, maybe 2% downside? That's your upside for being negative on Europe if you're trading it through the euro. But if you're wrong, this thing's going to be trading 140, 145, 150 in a matter of weeks.
Have you noticed the correlation between U.S. stock market performance and what's going on in the euro? It seems as though everyone looks at what happens to the euro and then they trade U.S. stocks off of that. You think that's going to continue?
Well, absolutely. And I think it's because when there's very little growth in the U.S. right now is relying upon growth in other countries, specifically in emerging markets. Now, over the past week, as the dollar has strengthened somewhat against emerging markets, dollar Brazil went up 20% over the last 3 weeks, and it's done the same thing against the rand, against Korea. What you find is suddenly that they're not selling as much to those countries, so obviously stock market gets hit. Now, if you see the dollar strengthen against the euro, and you see the euro then start to move up, then people feel more comfortable in emerging markets, will start selling dollars against the emerging markets, bringing them back lower, and the U.S. can now start selling again to the emerging markets countries.
Now, the latest book, Bill Cohan, on Goldman Sachs, you think that Goldman Sachs might actually have to, merge in order to produce better results?
I think in order for them to sort of, they made all their money, they made their bones as a firm in the last 2 decades by taking huge risks, huge proprietary risks with their own money and their investors' money, and making it pay off beautifully. I mean, they're geniuses at that. But we're in a new regulatory environment now, where whatever the Dodd-Frank regulations end up being written, whatever the CFTC regulations end up being written, they're not going to be able to take those kinds of risks that they used to be able to take. And you're already seeing that in their results now. So I think they need to become more sort of utility-like, more commercial bank-like, but without actually, having a retail face. And that's why I like this idea of them merging with Bank of New York Mellon. I mean, I can assure you that Lloyd Blankfein hasn't whispered anything into my ear. But once upon a time, John Corzine, the former CEO of Goldman Sachs, proposed a merger with Mellon Bank before it had merged with Bank of New York. This was in 1998, 1999, and it cost John Corzine his job because Hank Paulson, then the COO, heard about what he was doing behind his back, didn't like it, and then basically staged a coup d'etat that resulted in Corzine leaving the company and Paulson coming in being the CEO. But the idea, the basic idea between the merger between Mellon Bank and Goldman Sachs still makes a lot of sense because they have a big asset management business. They have a big, portfolio servicing business, and they don't have commercial banking per se anymore. So it's the kind of steady earnings that Goldman Sachs could really use and thrive on, as opposed to this volatility in their earnings, which we're going to be facing now as the investment banking business shrinks and they can't make the big proprietary trades anymore. Call me crazy, but I think it's the kind of deal that might save Lloyd Blankfein's job. Not that it's going anywhere, not that he's going anywhere, but it's the kind of thing that might make him look really smart.
I would never call you crazy, but I do want to know about, maybe it's an apocryphal story, but you mentioned John Corzine. He's now running MF Global.
Yes.
And Henry Paulson, who was
Once
the head
upon
of
a time was CEO of Goldman Sachs and Treasury
Secretary.
Yeah.
You say that they did not get along over this particular issue. Is it?
Well, they didn't get along over many issues.
Well, I was going to ask
Yes.
you, is it in fact, there was a story about that John Corzine would actually sit in his Lincoln Town car parked outside Goldman Sachs because they disliked each other so much at one point?
There is that story towards the end. This was after, basically Paulson had successfully staged his coup d'etat, which was in January and February of 1999, and then Corzine didn't leave the firm until Goldman went public in May of 1999. So there was talk of him sort of sitting out in his town car for those 3 or 4 months, but I'm sure that is not entirely true. I think maybe people saw him sitting in the town car making a phone call, but eventually he would come up to the office. But there's no question that the two men didn't get along, and they hadn't been getting along since 1994.
All right, Doug Borthwick.
Yeah.
Bill Cohen's idea about Goldman Sachs maybe doing a merger with Bank of New York Mellon. Tell me about the Forex trading platform at Bank of New York Mellon. They're a big...
It's a custodian.
Yeah.
It has tremendous amounts of flows and has been in the news lately because some people have been upset with some of the rates they've been given on their foreign exchange transactions. And this is something that State Street also got in trouble for. It's alleged that that when someone was trading with them, they didn't get necessarily the rate that they expected to, and that maybe something more was taken. So they're certainly in the news for that right now. But what would it mean for a GS and Mellon merger? I think it would be a tremendous amount more business for Goldman Sachs, because obviously if you have huge flows and huge funds, they have to transact. And right now they transact with the street. If it was captured internal business, it'd be fantastic for the guys on the trading desks at Goldman Sachs, because now they'd be making for an internal customer.
I'm glad you mentioned trading desks. Bill Cohen, this idea that many banks, including Citigroup, for example, they don't have, or they're getting rid of, their equity trading businesses. They're getting out of the prop trading in stocks. Is that just going to be accelerated as we look into the fourth quarter of this year?
I think this is what, where the Volcker rule is forcing, whatever the Volcker rule turns out to be. I mean, basically, firms like Goldman and Citi and others have reached the conclusion that they have to get out of these proprietary trading businesses. And in Goldman's case, they sold off, whatever it was, 9 traders and whatever the book was to KKR. And, how they make money has always been a bit of a black box at Goldman Sachs. But, I think what we need, frankly, I think, one good thing that's going to come out of the Volcker rule, if it in fact does come out, is that these investment banks become more utility-like. In other words, that they are getting back to what they used to be really good at, which was providing capital to companies all around the world, 24/7, debt or equity, providing M&A advice, providing investment advice, and getting out of the casino business. And I think that's going to be a safer business. We're going to be a lot safer if that, in fact, is the way Wall Street ends up being, having to go as a result of these new regulations. And I think you're seeing it in the Goldman Sachs earnings, except for the one-time stuff. Even if you take that out, I think their earnings, their revenues in those businesses are down, and their earnings are down.
Doug Borthwick, the idea that banks are getting out of these businesses, they'll be more like utilities. These businesses maybe, though, don't go away. Someone buys them or they become private entities.
Well, that's right. If you want to get rid of your prop traders, you create a fund. And you channel some money towards that, and then they trade the firm's money, but as an offset. I think you'll see a lot more smaller prop trading funds start to open up around New York.
I want to thank you, gentlemen.
Those trades through
the banks.
Through the banks.
I want to
Goldman
thank you,
Sachs.
gentlemen, very much. Doug Borthwick, Faros Trading, Bill Cohan, Bloomberg View columnist and Bloomberg contributing editor. Coming up tomorrow, it's Friday. Mystery guest. Thanks for taking stock.